So like I said on yesterday's video, I'm currently away at the moment, but I said if I do have time, I'll try record a video for you guys. So here I am trying to do a video for you guys in the lodge that we stayed in. I cannot though do the video talking and record at the same time. So in a second I'm going to get rid of this screen, but I don't know, kind of proof that I was away and not lying to you guys, but I don't know why that would happen anyway. But anyway, I'm going to stop this video now and just go on to the main screen anyway. And here we go. So we're going to talk about PayPal's earnings, Sofi's earnings. I said if there's anything big, I will talk about them. So yeah, pretty big move. So we're going to talk about them today. I have not listened to the full conference calls yet. I'll do that a little bit later on. And then on Patreon, I'll do any kind of other news from the conference calls into an earnings review on the Patreon. But from what I can see, I'll talk about PayPal today and I'll talk about Sofi's earnings today. And I don't know which one to start with. Should we go with PayPal? PayPal's one on the screen, so let's go with PayPal. Yeah, PayPal having a pretty good day. The stock is up, so it just jumped to 8%. It's up 8% today, and it's well deserved. The stock brought out their earnings, and they were good. The EPS was a good beat. I mean, I know this is non-GAAP EPS, but beat by 0.20, which is nearly 20% beat, which is insane. That we know that Alex Chris is focused on dragging out as much profitability as he can from the business now, and that's what's happening. So very good profitability, and that's I guess that's the kind of main thing that we look at now, because it is more of a value play. Revenue growth of 8.2%, which is very good. I think when we did yesterday's video talking about what PayPal could potentially do, I think a lot of analysts, I do have it somewhere around here, analysts were expecting more towards like high 7% range growth. If I do have them here, yeah, they were expecting high, or not even high, like 7% revenue growth. So this is very good beat. And even on the EPS, I did have the numbers somewhere for the EPS, GAAP EPS of, yeah, $1.19. And if we go back to PayPal here, the analysts were 0.99, which is the very good, a lot higher than what analysts were expecting. I've seen it mentioned, someone mentioned increased share buybacks. I don't know if that's there. Someone mentioned as well about something else. What was it? I can't remember. Maybe there was a slight guidance raise in some of the numbers. I've not got that far yet into seeing the numbers if there was a big raise, but that's some of the talk here. But yeah, overall, really impressive numbers. I mean, the EPS is obviously going up in the right direction with the share buybacks on top. 8% growth is what we want to see. I mean, like I said, the diamond here is Alex Chris, and he actually posted on X, Twitter earlier, and put some really good information out. And he's a wild card here. He came back in this is now a year on nearly since he came in as a CEO, and it's the time where we start judging him and going, is he doing a good job at the company? And it seems like he is. He's driving up that profitability. He's saying all the right things. He's getting that revenue growth going in the right direction. Is looking really good for PayPal, and these numbers they're doing as well, they're not just like average market valuation numbers. Like a lot of companies wish they could grow at like 8% a year and do this EPS growth that PayPal's doing. This is a above market company here, but yet you look at the company today and it's 15 times earnings, yet it's doing so many things that other companies wish they could do. It's a 13 times forward earnings, and yet the company is growing at these levels with the share buybacks on top. It's one of the most attractive valuations that I see right now in the market, and to get these levels of growth, and you look at the S&P 500, and the S&P 500 normally trades at like 19, let's call it 20 times earnings. The S&P normally trades at 20 times earnings. Apart from right now, it's absolutely insane what the S&P trades at. It's trading at like 28 times earnings, which is a different story, which I've covered on the YouTube channel, many times before. Is like, how can it keep doing this premium? But it's still surprising to me that you're seeing like the market normally trades at 20 times earnings. We have the market that's trading at insane highs at 28 times earnings, and yet we have PayPal sitting at 15 times earnings that's doing above financials, market average financials, and it's below a market average valuation. Like, it just doesn't make sense. And then obviously you got the wild card of that Alex Chris has come in from Intuit, and he's doing what he did at Intuit, and he's really driving the company up, and it doesn't make sense to me. Like, it's fair enough, like the stock is up 8% today, but even more past that, you look at the stock apart from the jump that we had today. I mean, the stock was sitting around below 60 again only a couple of weeks ago, and it had a bit of a bump off last earnings, and then it's gone back down to like the high 50s, 60 range, and it just doesn't make sense why it's here. I think this company should be at least a market average of 20 times earnings. Market average of 20 times earnings, you're easily looking at this stock should be at least $80 right now, right now, without factoring any of the growth in, without any of the share buybacks, this should be like 20 times earnings, and an $80 stock is what I should say. It just does not make sense. And the big question for me with PayPal now comes, like, I made it my third largest position, and it's been a good day today, but it doesn't, like, year to date, I mean, we're still down. We're up 4% year to date, but we're still way below the the market returns. The big thing I look at PayPal now is, like, it's my third largest position. Do I consider now breaking that into the top, two, the second largest position or the first largest or the biggest position in the portfolio? I mean, both of them are obviously DraftKings and HIMS, and they are both double the size of what PayPal is right now. Is that time to do it? Because the thing that always put me off about making PayPal my largest position is that I was happy about everything apart from the management change. I just wanted to see if Alex Chris could be a good CEO, and everything that I'm seeing, he is doing that. And I think, like, is this time to make it my largest position? That's the big thing that I'm kind of thinking of right now. But overall, from an earnings point of view, yeah, PayPal's earnings were 10 out of 10 in my opinion. Sofi total, I'm going to refresh this actually because I've not refreshed it since I started putting the video together. It hasn't really moved too much. The stock is down today, well, basically break even, I guess. Down 0.89%, so not much move from Sofi stock, which is probably more surprising than PayPal. PayPal, it deserved the jump in the share price. Sofi, in my opinion, with these numbers, I thought was guaranteed with a share price jump with the numbers that they've just brought out. It's very rare you see a company do what SoFi's done, which is the beat on EPS. On a revenue point of view, they grew 22% year over year, which, by the way, I think we talked about on the preview on Monday or yesterday. It seems so long ago now. We talked about, like, analysts were expecting, like, what was it, 16% revenue growth, and they just did another 20% growth number. This is, a 30 million beat is no small beat. Very, very good growth. EPS beat, revenue beat, and then they go and hike up the guidance again. So this is, like, the third time they've done it this year. They've hiked up the guidance once again, and it's no small hike ups either. Like, the hike ups were very impressive. You look at the revenue, 625 to 645 versus the 612 million consensus. Like, even the low point is 10 million higher than the consensus. When you look at the EBITDA point of view, you look at the EPS point of view, all the numbers were higher than what we were expecting, and you get this triple beat from SoFi. You look at this. If you said to me yesterday, okay, this is SoFi's share price, and then they come out with a triple beat, should the company be valued more or less than yesterday? And you would say more, but yet the stock is actually worth less. The company's worth less than yesterday, even though they've just beaten EPS, beaten revenue, beaten outlook. And it's worth less. I mean, imagine if this company came in with a miss. Imagine if they missed EPS or revenue was a miss or the guidance were cut. Imagine what the share price would go now. And it's just so frustrating to see that you have a company that triple beats and yet the share price goes down. And it's not even the valuation. A few people would maybe point to valuation, and granted it is 86 times earnings, but it's just come profitable, so it's quite a hard metric to use. Within a few years, that's going to look very cheap, because if you look at the profitability the company's going to do, let's say it does 156 million profitability, 310 million, basically in 2 years time, let's say they do 550 million in profitability, which at the moment 6 analysts are forecasting. If they do that profitability and the company is valued at 7.6 billion market cap at the moment, within 2 years, if they do that profitability, there's no denying how cheap this company will be. Everybody was staring around like, hold on, you can get a 20% growth company for that sort of earnings. It would be absolutely crazy. And the thing with SoFi as well is, like, the metrics you can use. So if you look at, like, EBITDA, for example, which a few people have questions around EBITDA, it's not my favourite metric to use, but unfortunately you got to use what you've got at the time for a lot of these growth stocks. This is the thing with growth stocks. This is what I was saying earlier on the Discord, actually, is that, this is growth stocks. This is why growth stocks can be so volatile, is because there's no really clear kind of value. You're trying to see what profit they're going to do in future years. It's a lot easier when they're already making the profitability. When they're not making profitability, you can, like, trying to put the pieces together, like, what can they do? And when you look at SoFi's profitability pieces, they're coming together very well, because you look at the metrics that you can use. EBITDA, granted, maybe not the best metric out there, but They're currently trading around about 14 times EBITDA. I mean, you go by Block, which, by the way, I still think Block is very cheap, by the way, as all fintech is. I think there's a lot of opportunities in fintech. That's currently trading at, 29 times EBITDA. If you use free cash flow, they're currently trading at something like 14 something times free cash flow, something. You go by something like a Visa, for example, it's 28 times free cash flow. All the metrics are standing out cheap. The only thing is the PE. You can't really use the PE at the moment because they've just turned profitable. But right now, I mean, 80 forward times earnings if they keep doing what they're doing at growing at 20+% and they go at these sort of levels, the profitability they're going to do is insane. You're going to be talking about a very good growth company here at very cheap levels, and that's why I think Sofi, for me, I think it will double. And it's frustrating today seeing one of those stocks that bring out these earnings. This is the most frustrating time as an investor, because if it was the opposite way today, if this stock was as bad as as good as it is, if you flip the earnings report and if they miss by this much instead of beat by this much, if they missed by this much revenue instead of beat by this revenue, if they did the guidance downgraded as much as they upgraded, imagine what the stock would be down today. And it's frustrating. This is where it comes really frustrating, because then eventually you do get that bad quarter and you're like, well, I mean, how long have you been in a company for and it's never moved on the good earnings. This is the annoying thing with sometimes investing, is that over the longer term, 3-4 years, we will get the share price results. The clear ones, when you look at HIMS, for example, I mean, we had to put with 18 months of HIMS not doing anything, going down from, $6, $7, $8 where it already looked cheap, down to $3, and you're like, why? Because the numbers are just, so much better. We've seen it with DraftKings. It happened with my two largest positions. It's not something new to me here, but it is very, it's very frustrating seeing it happening again in real time. You just hope that eventually the market will put it to the right sort of valuation here. And I look forward to Sofi's numbers and the conference call. I think Anthony Noto's a good speaker. I'm sure he'll probably have already been on CNBC as well and given another good interview. I think he's one that I really look forward to, and a really good CEO. So we'll see what happens there with Sofi. It is a bit of one of those that's a bit frustrating to take today, but eventually, hopefully, the share price does kind of start reflecting the numbers there. I haven't put it on the title of today's video, but I just wanted to mention 2 or 3 more stocks, which I'm sure you don't mind about, because I know you like videos where I mention a lot of stocks in one video. Greggs, I just wanted to mention Greggs really quickly, because I say this all the time. I always focus on the stocks that are right now, but I never focus on stocks that I have made lots of money on, and I just kind of sit there. I never talk about my longest holding in my portfolio, which is Microsoft. I never talk about Microsoft, even though I'm up 300%. Greggs, one of the stocks that I really shouted at as it was my largest position during the whole COVID situation, and obviously I sold half of it off now, but I still own half of it, which is up over 100%. And I never talk about it. And I always think, it's always good to sometimes talk about your winners rather than all the time about what went wrong, things that are going wrong, stocks that aren't working out, Sofi. But actually talk about ones that you like, those decisions that you made a few years ago and they're doing really well. And Greggs is that. It's a stock that I'm up over 100% on, getting over a 4% dividend yield now with the average that I have, 22 times earnings. I don't even think it's that bad of a valuation, and they're bringing the numbers out today, and the numbers that they have just brought out as well have been very impressive. I mean, look at the sales, 844 million to 960 million, underlying pre-tax profit from 63 million to 74 million. Look at the dividend from 16p up to 19p as well. So impressive numbers, and it's still not even a bad valuation. This is a great thing about sometimes holding stocks forever now, is that I'm just getting a bigger dividend. The profitability now and the share price returns are just accumulating, multiplying, compounding on top, which is really nice to receive. And not even a bad valuation, which is a good thing, and one that you can just sit back now and just sit back and let it do its thing. Don't have to worry about Greggs at all, which is really nice to see. Nvidia having it's not a pretty day out there in the market overall, and Nvidia obviously a big reason for that, down 7%, having a big pullback. I mean, the thing is though, you look at Nvidia now, it's saying having a pullback, still up 117% year to date, but I've got to say, 60 times earnings now, growing at 262%. It's an interesting time for Nvidia now, isn't it? It's how much can it continue this kind of boom, or is it going to have that bit of a, you know, a bit more of a reality check on the share price? We'll see. CrowdStrike as well, another tough day for CrowdStrike, down 11%. I'm really happy I cut this one out, because it would have stung a lot having this one in the portfolio if I didn't cut it in time. And yeah, down 11%. But I think the ultimate question now comes with, you know, the fear is starting to, you know, pile on with CrowdStrike. You know, it is down now, you know, 41%. You know, what time does it kind of come an opportunity to buy CrowdStrike? I'm watching it. I did some numbers earlier, and I was posting on Discord that for me, I worked out that around about I think it's a 33 billion market cap is where I would potentially buy CrowdStrike, which is obviously still a bigger drop from where it is right now. You're talking what, 130? I'm trying to do quick maths in my head here. $130-ish maybe, $140. Yeah, even that looks like maybe a good little area of support potentially. Not that I know much about, pretending like I know things about technical analysts there, but yeah, maybe 130, 140, 150, somewhere around this range where it was back in mid 2023. Maybe that would be a very interesting range around there if it gets there. And with fear, you know, you can easily see it get there, but you know, maybe the buyer's coming by that time, so we'll see. So we'll keep an eye on CrowdStrike anyway. So those are my thoughts on PayPal so far, and a couple of other stocks, guys. Anyway, let me know your thoughts on PayPal. Are you continuing to buy now with them strong earnings? Sofi, what do you think is going on there? Do you think the short sellers are just running the stock down a little bit at the moment and pushing it down after those good earnings? Or is it just overvalued? Tell me what you think about Sofi. And apart from that, I hope you enjoyed the video. Hit the like button, and I'll see you in a bit.